So welcome to this video. In this video, we'll be discussing about efficient market hypothesis. So before discussing about efficient market hypothesis, we should know what are the three approaches to buy a share. The first one is fundamental analysis. The second is technical analysis. And the third is random walk theory. So first we'll discuss about what is fundamental analysis. So fundamental analysis is the calculation of a company's intrinsic value. So what is an intrinsic value is, normally a share has a current market price. Okay, so that is called as CMP, is called as current market price. Okay, so CMP is what is reflected in the in newspapers and in business magazine or in websites, okay, where you can find out the price of a company. But intrinsic value is what is the real worth of the company. So fundamental analysis helps to find out what is the intrinsic value of a company is. So how do we find it out? Usually to find out the intrinsic value, we need a business's financial statements. Then we have to analyze the competitors and what kind of market it is. We also have to analyze macroeconomic data, something like interest rate, employment data, GDP growth rate, the housing and infrastructure, and manufacturing that is happening in a country. So fundamental analysis actually includes the economic analysis, the macro things, the industry analysis, where we have to find out the competitors. Then we have to analyze the company data. So it's a step-by-step approach to find out the intrinsic value of a company. So this is the company's share price. So it tells you that over a period of 1 year, how the share price has gone up here and to a lower down here. So this is a share price. Now we will see how intrinsic value plays out. So assume we have done a lot of computations and calculations and we have found out 12,700 to be the intrinsic value of the company. So the intrinsic value would usually be a little bit stable around the 12,700, but in this case we will feel that 12,700 is the stable value. Okay, so what happens is the share price usually fluctuates around the intrinsic value. So at some places it will be below the intrinsic value is above the market value, and in some places the market value is above the intrinsic value. So what happens here is, whenever the share price is very high when compared to the real value of the company, we have to sell the share, and whenever the value of the company is higher than the market price, then in those areas we have to buy the share. So fundamental analysis helps us to determine this intrinsic value. So fundamental analysis maintains that markets may incorrectly price a security in the short run, but that intrinsic value will eventually be reached. So the value, the price of a company's share will always move around the intrinsic value. So we can also make profit whenever the current market price and the intrinsic value are moving apart. This is a brokerage's report regarding a company, and they say that they have found that suggests that we have to buy the company's share, and they say that it depends on the 12 times PE into the financial year 21 estimated EPS. When you multiply the PE into the EPS, okay, you have got the intrinsic value of the company, that comes to 1090. So I think the share price for the company, okay, the current market price for this company should be around something like 900. That's why the brokerage says that intrinsic value is 1090. So we have to buy the share. So from this example we can find out how brokerages are creating share reports and how they are pricing a share. This is a very small example, but there are many complicated models to arrive at the intrinsic value. So here we get the numbers. So he has taken the EPS number here. So the 12 is the P of the company. Okay, so 12 is the P of the company, and he has multiplied 90.7, and think that's how he has arrived at 1090. But if you see the P here, it's not 12 at all anywhere, but I think he has taken an average of these numbers, so he would have arrived at 12. So that's how they have computed, but you don't need to worry about how it's computed. We just need to know how fundamental analysis works. So in here we'll be like discussing about the technical analysis. See, technical analysis is a method where they don't even try to find out like what is the company, what is the products they are selling, what is the price that they are selling, or their competitors. They don't evaluate any of these things. For technical analysts, there are only like two things which are very important. One is the past price of the company and the number of shares that has been traded, which is called as a volume. So these are the two things which are very important for technical analysts. So technical analysts don't try to find out what the company's intrinsic value and all. Okay, that is not their work. Their job is to use the charts, okay, and other pattern tools to find out where the price will be in the future. So we'll see this chart here. So if you look at this chart, okay, the share price has been going down, then it has become flat, then it has become higher. So whenever the price goes down, it's called as downtrend. Whenever the price is on a sideways movement like this, okay, that is called as a flat trend. And whenever it goes up, it's called as a uptrend. Okay, so every share price has a particular trend over a particular period of time. So they will be like range bound only. So technical analysts use these patterns and these charts, and they try to find out where the price would be next. For example, the price is here. It based upon the data, they can tell whether the price would be going here, or it will be flat here, or it will be going down. Okay, so who will tell this? The technical analyst can easily tell where the price will end up in the future period. So for them, only two things are very important. So one is the share price, okay, and the number of shares which are being traded. So what's the difference between a fundamental analysis and a technical analysis? We'll see here. So fundamental analysis analyzes the economy, industry, and the company. In technical analysis, the price and the volume are taken into account. Fundamental analysis uses financial statements as their primary research data. Technical analysts use charts and patterns as their mode. And fundamental analysis usually works only when you take a longer term approach, like more than 1 year you have to take. Technical analyst works very well in a very short term time period, something in even in weeks, days, minutes, or even seconds. It works really well. So fundamental analysis is used by investors who want to invest in with the company for a long period, and technical analysis is used by speculators who just want to make money in a very short term period, who are not bothered much about how the company is going to do. So this is a major difference. But why should we know a difference between fundamental, technical? Why should we know all this? Is efficient market hypothesis is built upon these two blocks. So if efficient market hypothesis is correct, then trying to find out the value of a company through fundamental or through technical is just a waste of time. So that's what efficient market hypothesis argues. Okay, we'll see how their argument works. So now we will discuss about the random walk theory. So prior to the 1950s, it was generally believed that the use of fundamental or technical approach could beat the market. In the 1950s to 60s, studies began to provide evidence against this view. In particular, researchers found that stock price random in nature and cannot be predicted. These researchers were commonly known as the random walk theory. So what happened is in the 1950s, there were like lot of research that was like conducted, and they found that people cannot make a consistent amount of profit, either they use fundamental analysis or technical analysis. The reason why they found is that the stock price was random in nature, so there was no reason like you can predict the stock price. So as you cannot predict the stock price, then doing any kind of technical or fundamental research is waste of time. So these researchers put together is called as the random walk theory. That is, the price moves randomly. That's what the theory implies. They also found that the stock prices reacted to new information instantly. So the only thing that moves the price is the information. So in order to like understand the efficient market hypothesis, we'll understand like what is the definition of efficient markets. An efficient market is one which is efficient in processing the information. So whenever there's a news coming about the company, can it like digest the information? Can it like price the share accordingly? So the more perfectly the market is able to analyze the information and price it accordingly is called as a very efficient market. So in an informationally efficient market, the price of securities observed at any time are based on correct evaluation of all information at that time. So if we draw a chart, for example, if we draw a chart, so the price actually moves from like this to this to this to this to this. So every point of time, okay, every point of time, why the price is like moving upwards here or very high here or constant or falls or again rises is every point of this contains information up to this level. So this price contains information till this. So this price contains information till this point of time. So this price contains information up to this point of time. So the price of any security is a reflection of the information. Therefore, in an efficient market, prices immediately and fully reflect the available information. That is the definition of efficient markets. So there's something called the efficient market hypothesis. So efficient market hypothesis states that there are like three forms of efficient markets. Okay. So together all these three markets constitute the efficient market hypothesis. So we'll discuss what are these three market forms are. First one is called as weak form, the second one semi-strong form, and the third one is strong form. So we look at the EMH graphically. So we'll start from the theory here. In this diagram, the circles represent the amount of information that is included in each form of EMH. So weak form contains a less amount of information. Semi-strong contains a lot, that is, it includes the weak form or information also. The strong form information contains the semi-strong as well as the weak form. Okay, so the successive circles actually contains the inner circle information also. Note that the weak form covers the least amount of information and the strong form covers all the information. Also note that each successive form includes the previous one. So that is a very important point. So what is the information that is captured in weak form? In weak form, all the historical price and returns of a share are captured. In the semi-strong, the publicly available information are included. Plus, it also includes the historical price and returns. And the strong form includes all information, public and private. So it also includes all public information and all historical price and returns. So that's about the information content in each of the forms. So we'll discuss about the weak form of the market. So the weak form of the EMH says the past price, volume, and other market statistics provide no information that can be used to predict the future price. So the weak form says that it, even though you have the past price and volume and everything, you still can make money in the stock market. So we'll see why it says like that. If stock price changes are random, okay, so that is what we started with the EMH with. Every price is random in nature. So if stock prices are random in nature, the next price is also random in nature. For example, tomorrow's price or next month price or next year price is also random in nature. So one, if it is random in nature, how can you use past statistics and past data to forecast a future price? So when you can't predict the future price, then doing technical analysis is a waste of time. Price changes should be random because it is the information that drives these changes, and information arrives randomly. Okay, so you can't predict the information for a stock perfectly and all. So the information like randomly comes. For example, there is a sudden fire accident in the factory, means the information comes to the market. So the market will price accordingly and reduce the share price. Assume the company has one new export order, so the market will get this news and it will push the share price. So getting a fire accident in the factory or getting a new export order are all kind of a random kind of information. So we, each random information creates a new kind of a price. So we can't predict the information and flow and all in the market. Prices should change very quickly and to the correct level when new information arrives. This form of EMH, if correct, okay, repudiates technical analysis. So it says if weak form is true, then technical analysis is useless. Most research regarding the EMH suggests that the weak form efficient seems to be mostly correct. So it means that there's a strong evidence that weak form is correct and the technical analysis is wrong. So that's about the weak form of EMH. So we'll see a picture. So any news comes to the market, and there are several people who are going to use this news and buy and sell shares. There are small shareholders like you and me. There are high net worth investors, pension funds, sovereign wealth funds, mutual funds. All these are investors, and all of these people are trying to guess what would be the share price after the news. And once they all get the news, the share is like bought and sold, and it will arrive at its correct value. So this is the weak form of EMH. So how does the price get adjusted? So for example, we look at the coronavirus impact on a share price. So this is State Bank of India's share price. So it was trading at 250 rupees at a point of time. I think in December also it was trading at 350 rupees. But once the corona news has arrived in India, the share price actually fell down. So why do you think it fell down? Because because of coronavirus, the new loans to be issued is going to be reduced, and people who have already got the loans cannot pay their EMI properly. So the income is affected. As income is affected, the share price is affected. So look at how quickly the market is able to digest the information about corona news, and it's like pricing the share. So we'll move on to the next topic. It's called a semi-strong form. So this form of pricing efficiency arises when share prices fully and fairly reflect all relevant and publicly available information, which includes past information. So semi-strong includes the weak form information also. So this model states that public information cannot therefore be used to make abnormal gains. Okay, cannot be used to make abnormal gains, since capital markets and share price quickly and accurately respond to new information. So It says that even if you have publicly available information, you won't be able to make money in the stock market. The reason is there are like so many players out there. So just because you have read an annual report of a company and you have analyzed it, it doesn't mean that you have some kind of a ability to know what is going to happen in the share price. Because not only you, there are like several investors like you who are trying to guess with the balance sheet and the P&L and the annual report of a company what the share price of the company would trade at. So as there are so many people, it becomes like a perfect competition. In perfect competition, you cannot make abnormal gain. So well-developed capital markets are held to be semi-strong, efficient, because there are so many people who are analyzing the annual report of a company. So public available information is just waste of time, and that is what research has proved for semi-strong information also. So the semi-strong form, if correct, okay, it rejects the fundamental analysis. So doing fundamental analysis and trying to find the exact price for the company or the intrinsic value of the company is just waste of time, because there are so many people who are doing the analysis and you are just one among them, and everyone possesses the same kind of knowledge, and that knowledge you cannot use as a edge to make money in the stock market. Most studies find that markets are reasonably efficient. That is, so in some countries, semi-strong form seems to be correct, and in some countries, semi-strong form does not work. So that is about the information here. So types of investors we look, why we won't be able to make money in the stock market as per semi-strong form is. See, there are like so many types of investors against you. You have pension funds, you have government pension funds, you have insurance companies, you have corporate tax plans, you have sovereign wealth funds, you have endowment funds, you have central banks. All these are shareholders or are investors in stock market, and all of them are trying to make money from the stock market. So as the market is like perfect market, so many people are there to analyze, we can't have an edge over the these investors. So we'll move on to the last form of efficient market hypothesis. So this form of pricing efficiency arises when fully and fairly reflect all private information as well as public information. That is, it says even if you are the CEO of a company and you have private information or insider information about your own company, you still won't be able to make money in the stock market. Do you think it is correct? Okay, so that's what they again say. Even if you're a CEO and you have insider information, you won't make money in the stock market. See, the reality is this form of efficient market hypothesis is not at all. Most studies have found that the markets are not efficient in this sense. That is, this semi-strong form does not hold in reality. That means if you are a CEO of a company, you know whether your sales is going to go up or down, whether you will have good profit in this year or not. You have a lot of insider information. So these information are only you know it, or the only top management knows it. Public people cannot know it, investors will not know it. So what you can do is you can make money before telling this information to the stock market. Okay, stock market is informationally efficient. They can process the information in annual report or in sales report or anything they can process, but they cannot process an information which has not gone out of the company. So what happens is, if you're a CEO of a company, you can make abnormal profits. In reality also that happens. That is why governments state that insider trading or dealing is strictly prohibited. So any CEO who is caught in insider trading will be like thrown in jail. So insider trading works like this. So two women in a company, employees in a company, they are discussing. The head of pharmacology is going to blow the whistle on the two side effects of our blockbuster drug. Okay, so she passes on an insider information to her colleague, and her colleague feels that got to sell shares now, because see, if he blows the whistle about the side effect of a particular drug, okay, the sales will fall out. So if sales are going to fall, then share price will fall. So if this woman has 100 shares at 100 rupees, she is having a net worth of 10,000 worth of share. So if the share price is going to fall to 50 rupees, then her net worth will be 5,000 rupees. So she has to incur a loss of 5,000. So what she could do is she will sell her all her shares at 100 rupees itself. So she will safely escape the market price collapse. So we look at a quiz now. This question was asked in December 2014. An investor believes that they can make abnormal returns by studying past price movements in terms of capital market efficiency. To which of the following does the belief relate? Okay, so someone feels that they can make money through past share price movement. Okay, so they believe in technical analysis. Fundamental analysis is using annual reports. Operational efficiency is not a valid choice. Technical analysis is what they are trying to make money from. Semi-strong is again not a choice. So we'll see. Look at the answer. So the answer is C. Now we look at the features of efficient markets. So stock markets that are efficient or semi-efficient are therefore markets in which the prices bought and sold reflect all relevant information available to the buyer and seller, and share price change quickly to reflect all the information about the project. So the share price movement captures all the available information. No individual person can dominate the market. Transaction costs of buying and selling are not very high, so that people are like encouraged in trading the shares. Investors are assumed to be rational in nature, so they are able to value the share in a very perfect and logical way. There are low or no cost of acquiring information. So only when these assumptions are holding true, then the efficient market hypothesis works. Okay. So if any of these are not going to be there, then the market can be inefficient in nature. So we'll see the impact of efficiency on share prices. If the stock market is efficient, share prices should vary in a rational way. If a company makes an investment with net positive NPV, okay, then the market will understand that it's really good for the shareholders, and the share price will increase. If a company makes a bad investment, okay, even before the investment is like materialized or it's like accepted by the company, the share price will collapse. So assume that a company wants to buy another company which is like poorly performing, and the market senses this is a very bad deal, then the share price will immediately fall. There is no point, for example, in trying to identify a correct date when shares should be issued. So whenever the company is trying to issue shares, they don't need to worry about the timing, the date or anything like that, because if it's a really good share, there are investors who know its real worth and they will come and buy the shares. If the company is like not a good company, so whatever time we sell the share, still we can't make money. The market will identify any other attempt to window dress. So if a company is trying to manipulate or cheat, the market will understand it. If the company is looking to expand, the directors will be wasting their time if they are trying to find out target companies whose shares are undervalued. For example, you run a company, your company is trying to buy another company, you feel that the other company share price should trade at 10, but it's trading at 20. So that is a reason why the other company's shares are traded at 20, because the company might be poorly performing, or the assets might be outdated, or the assets might be depreciated, or the employees are so totally demotivated. There is some reason why 100 rupees worth of company, which you feel is 100, is trading at 20. So the market actually has a higher amount of knowledge than we do. So you should not buy the company's share at 20 and believe that it can be traded at 100. This will not happen. The share will only trade at 20. So hence there is nothing which is called as undervalued. So we'll come to the summary of EMH. If the weak form of the market is correct, then doing technical analysis is waste of time. If semi-strong form is correct, then doing fundamental analysis is waste of time. If strong form is correct, okay, then insider information is also just waste. But in reality, the weak form and strong form are we have evidence that weak and semi-strong form are existing, but strong form is not at all existing. Okay, so that's how researchers have found. So it's waste of time to do technical, it's waste of time to do fundamental, but it's not waste of time to get inside information. You can get information and you can make money. It is unlikely that any system of analysis could consistently and significantly beat the market over the long run. Okay, so whatever methodology you have, you still can't make money in the longer period of time. So we'll move on to the quiz. This question was asked in September 16 specimen exam. Gurdeep plots the historic movements of share price and uses this analysis to make her investment decisions. To what extent does Gurdeep believe markets to be efficient? Okay, so she's trying to use historical price movements and she wants to make money. So which of this she is trying to believe in? Okay, she is not at all believing in efficient markets. She believes that the market is not at all efficient. That's why she is trying to make money in the stock market. So A is the answer. So this question has been occurred in the past exams in terms of December 2015 or in June 2014. So you can go through these questions and you can find out like how ACCA is trying to ask questions in EMH. So thank you very much for watching this video. We'll meet in the next video.